Hello students, in BCom second year, semester 3, we have a subject by name Principles of Insurance. This paper is SEC paper. SEC means Skill Enhancement Course. So here in this subject, we will be studying about risk management and insurance business and market, insurance terminology, insurance customers, insurance contract, insurance products. In today's class, let us focus in understanding risk management. Let us know about different types of risks, how to manage risk. Let us know about insurance, its origin and nature, importance of insurance, etc. So, first let us understand what is risk and what are the types of risks. Risk can come from various sources, including uncertainty in financial markets, threats from project failure, legal liability, credit risk, accidents, natural causes and disasters, events of uncertain and unpredictable root cause. Risk management is the logical development and implementation of a plan to deal with loss. The purpose of risk management is to manage an organization's exposure to loss and to protect its assets. Risk management benefits all types of organizations facing losses, including business, non-profit organizations, individuals, and family. Risk management is a dynamic process. Large corporations change frequently. They introduce new products, new services, merge, acquire or sell operations, increase or decrease of capital cost. Each time an organization changes significantly, it should review, and if necessary, they have to update the risk management plan. If you see the definition of risk in the world of finance, risk management refers to the practice of identifying potential risks in advance, analyzing them, and taking precautionary steps to reduce the risk. Risk management refers to the architecture that is used to manage risk. This architecture includes risk management principles, risk management framework, and also risk management process. Risk can be classified into several distinct categories. Some of the major categories are financial and non-financial risk, static and dynamic risk, fundamental or group, and particular, that means individual risk. Group versus individual risk or fundamental versus particular risk. Pure and speculative risk, quantifiable and non-quantifiable risk, financial and non-financial risk. If any risk is concerned with financial loss, we can say it as financial risk. Financial risk involves the simultaneous existence of three important elements of a risky situation. Someone is adversely affected by the happening of an event. The assets or income is likely to be exposed to a financial loss because of an event. Peril means cause of loss. Loss occurred due to damage of property, theft of property, loss of business, or any financial loss. They all come under financial risk. And we can measure them in monetary terms. When the possibility of a financial loss does not exist, the situation can be referred to as non-financial in nature. For example, selection of a career. It is non-financial in nature. Next, let us discuss about static and dynamic risk. Situation wherein the business environment is not significantly affected over time, then it is called as a static risk, and this static risk is insurable. Coming to the dynamic risk, speculative decision where gain, loss or breakdown, exposure to loss from changes in the environment such as fashion, tastes of the customers, any regulatory requirement, they all come under dynamic risk, and such type of risks are not insurable. Coming to the group versus individual risk, or we can call it as fundamental and particular risk. A risk is said to be a group risk or fundamental risk if it affects the economy or its participants are on a macro basis. These are impersonal in origin and consequence. They affect most of the social segments or the entire population. Floods, earthquakes, war, unemployment, etc. They all come under group risk or fundamental risk. Coming to the individual or particular risk, here small group, theft, robbery, fire, particular in nature, some of these are insurable. Pure and speculative risk. Pure risk is a category of risk in which loss or no loss is the possible outcome, and there is no possibility of gain, and such type of pure risk can be insured, home insurance. Speculative risk is a category when undertaken results in an uncertain degree of gain or loss. All speculative risks are made as conscious choices and are not just a result of uncontrollable circumstances. Trading in stock market, we may get profit or we may get loss. So, such type of risk is called as a speculative risk. Quantifiable versus non-quantifiable risk. Risks which can be measured are known as quantifiable risk. The risk which we cannot measure are known as non-quantifiable risk. Non-quantifiable means any stress or loss of peace of mind, non-quantifiable. Okay, now let us focus on how to manage this risk and what are the techniques used. Management of risk is the process of evaluating the risk faced by a firm or by an individual and then minimizing the cost involved with such type of risks. Any risk entails two types of costs. The first is the cost that will be incurred if a potential loss becomes an actual loss. An example is the cost of rebuilding and re-equipping an assembly plant that burns to the ground. The second type consists of the cost of reducing or eliminating the risk of potential loss. We would include the cost of purchasing insurance against loss by fire. These two types of costs must be balanced, one against the other, if the risk management is to be effective. So there will be two types of costs. First cost is loss becomes an actual. Example, cost of rebuilding and re-equipping. And the second type is reducing or eliminating the risk. Okay, coming to most of us think of risk management as simply buying insurance. However, insurance, although an important part of risk management, it is not the only means which deals the risk. We have other methods, less costly in specific situations. For example, uninsurable, not even an insurance company will issue a policy to protect against them. See, generally we have risk management techniques like how to avoid the risk, how to reduce the risk, how to assumption, okay, and how to shift the risk. See, avoiding of risk is risk avoidance. An individual can avoid the risk of an accident by taking certain measures, okay, by following the traffic rules. We can be safe, okay. Similarly, a manufacturer can avoid the risk of product failure by refusing to introduce new product. This is called a risk avoidance. But what happens now here, once you avoid it, there is a very high cost is involved. No person or business can eliminate all risks, but we have to take risks. Okay, so we can't avoid everything. So to avoid an accident, you follow the safety rules. Okay, similarly, to launch a new product, you take measures which help you to compete with your rival, and you take such measures which makes the customers satisfied about the product, and you follow certain techniques of advertising such that your product reaches the customer and your sales improve. So every time we can't avoid the risk, we have to take certain measures and we have to overcome the risk. Similarly, how to reduce the risk. If a risk cannot be avoided, perhaps it can be reduced. An automobile passenger can reduce the risk of injury in an automobile accident by wearing a seat belt. Okay, a manufacturer can reduce the risk of product failure by product planning or market testing. Okay, cost of reducing this seems to be well worth the potential saving. So therefore, when compared to avoidance, better to concentrate on risk reduction. So therefore, every business will have risk, and how best we can tackle the risk is very important. For that, we have to follow certain procedures, and also we have to take certain good decisions such that we can avoid the and reduce the risk. Next is the risk assumption. An individual or firm will probably take on certain risks as part of living or doing business. Generally, it makes sense to assume a risk when one or more of the following conditions exist: potential loss, effective risk management has reduced the risk, insurance coverage, no other way of protecting against the loss. Large firms with many facilities often find a particular kind of risk assumption called self insurance, a practical way to avoid high insurance cost. Self insurance is the process of establishing a monetary fund that can be used to cover the cost of a loss. So, just you are assuming if any untoward incident takes place or risk takes place, how to overcome such type of loss. For that, you are planning in advance. Your self insurance is the process. You are creating a fund and you are making you are taking insurance policy to overcome such type of risk. That is called risk assumption. Next is shifting the risk. Common method of dealing with risk is to shift or transfer to an insurance company. An insurer means insurance company is a firm that agrees for a fee to assume financial responsibility for loss that may result from a specific risk. The fee charged by an insurance company is known as premium. A contract between the insurer and the person or firm whose risk is assumed is known as insurance policy. So, what the contract between the insurer and the insured is known as insurance policy. Insurance companies will not, however, assume every kind of risk. A risk that insurance companies will assume is called an insurable risk. A risk that insurance companies will not assume is called uninsurable risk. Pure risks are insurable, whereas speculative risks are uninsurable. Now, how to reduce, how to loss minimization techniques. Loss minimization techniques are designed to reduce loss. You can reduce the cost. Okay, and for this we have some tools: risk avoidance, loss prevention, loss reduction. Risk avoidance. Sometimes the best method of dealing an exposure to loss is to avoid all possibility of the loss occurring. It may mean not introducing a new product, ending production of an existing product, discontinuing some operations, or selecting a business location where a particular peril is not present. So that is called risk avoidance. Loss prevention. Successful loss prevention activities lower the frequency of loss. So long as the benefits exceed the cost, firms should use loss prevention to treat all exposures. Assume or transfer to commercial insurers. The foremost purpose of loss prevention is to preserve human life. Risk managers' first goal in a loss prevention program is to reduce or eliminate the chance of death or injury to the people. Large business often employ loss control engineers to identify sources of loss or injury and to institute corrective actions. Loss control programs can be developed and implemented such that we can reduce the problems, and at the same time it takes a strong commitment by the management and constant attention by the risk manager to reach the desired goals. So how best we can prevent the loss, that is the role of the risk manager. Now coming to the loss reduction, successful loss reduction activities reduce loss severity. The best loss prevention efforts, some losses may occur. Loss reduction activities aim to minimize the impact of loss. So, excellent example of loss reduction is automatic fire sprinkler system, such that the fire can be, we can prevent the fire accident, we can also prevent the spread of fire. Okay, so such type of techniques definitely they help to reduce the loss. Next, let us know about the insurance, its origin and nature. Insurance can be defined as a legal contract between two parties. One party is called as insurer, undertakes to pay a fixed amount of money on the happening of a particular event, which may be certain or uncertain. The other party, called insured, pays in exchange a fixed sum known as premium. The insurer and the insured are also known as assurer, underwriter, or assured respectively. Document which embodies the contract is known as policy. Origin. The concept of insurance is believed to have emerged almost more than 4,000 or 4,500 years ago in the ancient land of Babylonia, where traders used to bear risk of the caravan by giving loans, which were later repaid with interest when the goods arrive safely. The first insurance contract was entered by the European maritime nations in 1347 to accept marine insurance. The concept of insurance, as we know today, took shape in 1688 at a place called Lloyd's Coffee House in London, where risk bearers used to meet to transact business. It became one of the first modern insurance companies by the end of 18th century. The oldest life insurance company in existence today is the Society for the Equitable Assurance of Lives and Survivorship, known as Old Equitable, and it was established in England in the year 1756. The concept of reinsurance emerged to deal specifically for such situations. Industrialization, urbanization popularized the concept and growth of insurance, and they led to the development of the new insurance products. Nature of insurance. We can, by nature of insurance, we can know it is a device for sharing risk by large number of people among the few who are exposed to risk by one or the other reason. A large number of subscribers to insurance serve the purpose of compensation to few among them exposed to uncertain risks appear as a cooperative look. Valuation of risk is determined as per predefined terms and conditions of the insurance policy. Insurance provides facility of financial help in case of contingency. However, it depends on the value of the insurance for which payment is made in case of contingency. Accordingly, amount is to be paid. Insurance is a policy regulated under laws, and therefore the amount of insurance can neither be paid as a gambling nor charity. Pooling insurance. Insurance pooling is a practice wherein a group of small firms join together to secure better insurance rates and coverage plan by virtue of their increased buying power as a block. This practice is primarily used for securing health and disability insurance coverage. Small business enterprises have long complained that insurers give discounts to clients who have submitted purchasing power and large number of employees. See here, private business, they are organized their own pools. Distinct entities have been created to address both health and disability coverage needs. We have health insurance pools, disability insurance pools, health insurance pools, which are sometimes called insurance purchasing alliances or health insurance purchasing cooperatives to address this problem. They provide group health policies exclusively to small business. Rules governing these alliances vary from state to state, with some states offering eligibility to sole proprietorships and others providing coverage to business with up to 100 employees. On an average, these health insurance pools target employees of 3 to 50 people. Disability insurance pools. Disability insurance pools, also called as risk purchasing groups, operate under the same guiding principles as health insurance alliances. By joining together into one single negotiating group, small businesses can increase their bargaining power when dealing with insurers. These groups are usually composed of companies that hail from the same industry sector and thus face many of the same disability risks. Coming to the different classes of insurance. Insurance can be categorized into life insurance and non-life insurance. Non-life insurance can be further classified as general insurance, miscellaneous insurance. General insurance includes marine, fire, personal accident insurance, automobile insurance. Miscellaneous insurance consists of burglary, crop insurance, cattle insurance, flood, health insurance, public liability insurance, etc. So, life insurance contract. A life insurance contract is a contract where an insurer agrees to pay a certain sum either on the death or after the expiry of a certain period in consideration of a premium to be payable by the assured. The basic function of a life insurance is to protect the insured against the financial needs which may arise due to death or disability or old age. General insurance services, marine insurance services, insurance contract in which the insurer agrees to indemnify the insured in a manner and to the interest thereby agreed against loss incidental to marine adventure. Marine insurance facilitates safe and secure import and export of goods, and it renders very good service with respect to foreign trade. Fire insurance services. Fire insurance gives protection against loss due to fire, consequent upon fire, loss of property due to stoppage of production, certain other risks like war risk, turmoil, riots, etc. can be covered by fire policy. Personal accident insurance. This insurance contract is a supplement to life insurance. It provides an ideal protection against death or disability due to the accident. It is a contract whereby insurer agrees to compensate the loss suffered by the insured or his kith and kin due to death or disability arising solely and directly from accident caused by violent external or visible means. Automobile insurance services. It is popularly called motor insurance or motor vehicle insurance. Motor Vehicles Act 1939 provides for compulsory insurance for third party liabilities arising out of the use of motor vehicles. So, coming to the miscellaneous insurance products, fidelity insurance. This type of insurance is called fidelity guarantee insurance. It is a contract whereby the insurer agrees to indemnify the employer against direct loss to which he may subject due to acts of fraud or dishonesty by an employee in the course of his employment. The insurance does not guarantee the employee's honesty. Burglary insurance. It is important as fire service. Under this contract, the insurer agrees to indemnify against any loss or damage of household goods. Burglary, theft, housebreaking, everything covers under burglary insurance. Next, crop insurance. This type of insurance has been devised to extend financial support to farmers during the time of crop failure because of drought. Cattle insurance. Insurance contract provides indemnity in the event of death of insured cattle like bulls, buffaloes, cows, etc. Flood insurance. Flood insurance is a contract whereby the insurer agrees to indemnify the insured for any loss due to flood. Health insurance. The insurer agrees to indemnify the insured for any loss suffered by him during the time of hospitalization or injury sustained. Engineering insurance. The insurance gives protection against any loss of the construction site of civil engineering projects designed to protect engineers, contractors, etc. against any loss in civil engineering projects like building, bridges, tunnels, etc. Public Liability Insurance. Public Liability Insurance Act, all companies and persons owning and dealing in hazardous goods which may cause loss of public due to accident, body injury, disease are required to pay this policy. Cash in transit. Insurance policy in which the insurance company will compensate amount if the money is stolen or lost, it is being moved between two places. Importance of insurance. It protects against loss, it motivates saving, spreading of risk, promotion of efficiency, elimination of dependency, meeting of different needs, best avenue for investment, maintenance of normal profit, welfare of employees, instrumental for capital formation. So, the main service of insurance is to provide certainty of payment at the uncertainty of loss. Safety and security is provided against any possible loss to the individual or to the group of individuals. Motivation for saving. Life insurance companies not only give protection but also encourage people to save by giving various incentives like bonus, tax benefits, etc. Spreading of risk. The very important service rendered by an insurance company is to spread the risk or loss or damage among those who are exposed to risk. It serves as a cooperative device to share the risk by many people through spreading the risk among them. Promotion of efficiency. Insurance gives peace of mind to the insured by eliminating uncertainty of risks. All worries attached with those risks. It enables the insured to concentrate on his work without any anxiety. Elimination of dependency. In the event of death of the breadwinner, destruction of property, the entire family would be placed in a pitiable condition to face the sufferings and to depend on others for help. Insurance relieves from such dependency and assists by providing adequate sum at the time of their sufferings. Meetings of different needs. Insurance looks after the different needs of a person, such as old age, retirement needs, educational needs, marriage needs, etc. Best avenue for investment. People can make use of insurance as a profitable avenue for investment, especially life insurance policies. The premium paid by the insured is a kind of saving since he is assured of a certain sum with profit after the expiry of a certain predetermined period in the case of endowment policy. The policyholder gets bonus, tax benefits, etc. on his investment besides getting life protection. Maintenance of normal profit. Fire insurance policies not only protect the loss of goods but also cover the loss of profits during the stoppage of production till normalcy is restored. Such that it enables businessmen to maintain the same level of profits during stoppage of production. Instrumental for capital formation. Insurance companies collect the idle savings of the people in the form of insurance premium and invest them in shares and debentures of companies and government securities. Thus, savings are diverted towards productive ventures. Thus, insurance companies act as a catalyst for capital formation. So, with this, we can stop here, and almost we have got a brief idea with respect to risk management and insurance. We are able to know about the risk management, we are able to know the insurance, its origin and nature, and also we got an about the importance of insurance. Thank you.